you all today. Thank you for joining on a Wednesday. Just a show of hands, who here has heard of CTVC or Climate Tech VC or are subscribed? Oh, wow. Wow, this is the most proportion I've had. This is great. So for those who don't know, CTVC is the leading source on climate tech. We started off as a newsletter at the beginning of 2020, tracking what was happening in what was then still a very nascent climate tech space. And now we've grown to over 50,000 subscribers on the newsletter front, and we're building out a lot more behind the scenes. So we're building out a lot of research and data, market insights on the state of climate tech funding, but also going deeper into sectors, understanding how innovation is now shifting over to deployment and projects as well. So for those who are interested to learn more about what we're doing, feel free to hit me up after this. Here's some really colorful charts we've put out in the past. We just published our H1 funding report, State of Climate Tech, which I'll talk to a bit here. So as Stafford mentioned, in order to understand the state of climate tech investment, one of the key challenges in the beginning is to understand what is climate tech. And it sounds like a lot of you here read CTVC and know and spend time in climate tech, so I won't spend too long on this, but we look at climate tech across 7 broad verticals. We look at it across monitoring, so climate management solutions, emissions accounting, remote sensing. We look at it across mitigation, so how do we decarbonize emissions-intensive industries like energy, food and land use, transportation, built environment, and industry. And then finally, we have this third kind of vector of how do we actually deal with it, and that's adaptation and removal. So starting to shift to a world where climate change is here today, so lots of innovation areas we're seeing like climate risk and insurtech, also carbon removal or methane removal solutions for removing existing emissions in our atmosphere. And of course, this wouldn't be climate tech if we didn't spend a slide talking about emissions. So here we have on the left-hand side, here on the left-hand side we have the percentage of global GHG emissions. And at the top we can see the majority of that is from the energy sector, food and land use industry, and so forth. On the right-hand side, we've tracked deals since 2020 based off these verticals as well. And we can see, there's a little bit of disconnect here, but for the most part, it's relatively correlated. Innovation deal activity is relatively correlated with the percentage of emissions. And then if I switch this view to funding by sector, this starts to get a little bit more disconnected. So we've seen lots of funding towards solutions in transportation, about 44 billion since the start of 2020, and not as much funding towards verticals like industry or built environment that are significant emissions verticals, but so far there's been a bit kind of slower amount of funding going into those verticals. Now, if I zoom in a bit, we looked at that at the vertical level. Let's zoom in a bit into the sector level. So in addition to looking across these broad 7 verticals, we look at 60 plus sectors. Then we break that even down further to 200 plus technologies. But I won't show 200 because then you can't say anything. But here, again, we're looking at the deals view. So funnily enough, over 8% of the company's view, 8% of the companies we've looked at are in alternative protein and foods. So lots of Beyond Meats out there. But then again, if I switch to the funding view, we see that effect in transportation again. So about 30% or so of funding have gone into solutions in electric vehicles, autos, batteries, especially driven by, I think, the last few years of SPAC activity. Lots of kind of growth stage mega deals going towards companies like QuantumScape, Nikola, and things like that. So this is from our recently published H1 funding report. I think a lot of people in the room here who have been partaking in climate tech or tracking what's been going on in the space have seen a very significant uptake in funding and deals since 2020. We've tracked over $117 billion of venture and growth funding deployed into climate tech since the start of 2020. But obviously, we're in a market slowdown since the second half of 2022, and climate tech has been somewhat affected by that. So we've tracked about 40% decline in H1 2023 compared to the prior year. However, I'll caveat that if we look at the overall venture funding market, PitchBook has tracked that's down about 50%. So you could say that climate tech is somewhat resilient compared to the overall venture and growth funding market. And then what's interesting here is if you look at that green line, that's the count of deals, deal activity has remained relatively resilient. And a lot of that is because there's still this pretty strong growth in early stage deals, seed, Series A stage deals, but a pretty significant drop off in growth stage deals. And we can see this view across verticals as well, where a lot of those sectors like transportation, energy, and food and land use, which have historically made up the lion's share of funding, have significantly dropped off in this last half year. But we have seen some green shoots in industry and built environment, so a silver lining in all this, especially since those were kind of the two verticals we pointed out earlier that did have that disconnect. My hypothesis is a lot of that might have been driven by the Inflation Reduction Act, a lot of funding now going into heat pumps and other solutions like that. And then shifting the view to stage, to Stafford's point earlier, despite the kind of maturation of these climate tech companies, we're seeing a pretty significant drop-off in growth funding. So that's Series D plus, Series C sort of funding. So about 60 to 70% decrease H1 2023 compared to the prior year, which is a pretty significant gap if we think about how a lot of these companies that started at the beginning of climate tech now have to move towards that Series B, Series C stage. So something to think about as the climate tech ecosystem continues to evolve. We did a market sentiment survey actually before putting out this H1 funding report. So this is at the end of December because venture funding is inherently a bit lagging, at least the announcements are. And so we wanted to understand, what does real-time investor sentiment look like at the end of 2022? And this matches pretty well with the data. We saw that 50% of investors said they were intending to deploy slower, and majority of that was happening at the Series B stage. So you can see that majority of that teal bar there said Series B investors intended to deploy a bit slower. So investor data also, sentiment survey also matching to that data. One of the analysis we've recently done is looked at exits across the space. Obviously for investors in the room, what matters at the end of the day is returns and exits, in addition to climate impact, of course. I think the main takeaway from this analysis is that it's still a bit too early to tell. We have seen exits rise 70% year over year, sort of seem to be on track for that 2023 year date. But when you zoom into this, when you zoom into the different color bars, about 60 to 70% of that were acquisitions, another 25 to 30% were SPACs, and then the remaining 6 to 7% were IPOs. And 80% of those acquisitions were undisclosed. So it looks like a high number, but I think when you zoom in, it's still a bit too early to tell whether these were, good performing returns or not. But at the end of the day, it takes about 9 years for these companies to exit. I'd say we're about 4 to 5 years into this cycle. Again, kind of emphasizing the point that there is that gap in Series B plus funding, especially for a lot of these companies, if they started in 2019, 2018, to start to reach those stages. There's two specific tailwinds I want to talk to, though. We've talked a lot about that, growth funding gap. One is policy, and here we talk about Inflation Reduction Act, but I know there's a lot going on in the UK. I think what was particularly exciting about the IRA is that it's no longer just about solar and wind. It's really taking a full kind of holistic climate tech approach to policy. So we're looking at tax incentives for energy, for transportation, but beyond solar and wind for hydrogen, battery manufacturing. We're seeing tax credits for carbon. We're seeing incentives for heat pumps in built environment, food and land use, and industrials as well. And we did a quick back of the envelope math and projected that if you take the kind of full tax credit for some of these technologies, it could decrease some of these climate tech costs by around 40%. So significantly putting these technologies cost competitive. The other key tailwind I want to talk to here, and hopefully a lot of people in the room either are on this slide or recognize some of the logos on this slide. There's a lot of dry powder out there. So we've tracked about now over $100 billion of new money in the game since 2021. A lot of funds that have announced in this over $500 million amount. So there is capital, there is dry powder out there. A lot of the slowdown we've seen is from real-time investor slowdown. So we still do think that there's a lot of capital that's kind of waiting on the sidelines to fund these companies, but right now taking a step back as the market kind of slows. So this is one tailwind I think that'll continue to keep climate tech sort of warm through this winter. And now looking at the climate capital stack, we've talked a lot about venture and growth, but that's not the only form of capital that's critical to funding climate tech. There's, at the early stage, grants, catalytic capital. There's also venture debt. And then as these solutions start to mature, a lot of climate tech is hard tech. It's building projects, building facilities, building plants. We want to see more project finance, commercial debt start to enter the stack as well. Here we've looked at and very closely tracked a lot of VCs in this space. We started doing this in 2020, and there were 200 VCs we tracked. Now there's over 500 or so. You can scan this to see the running list, and we continue to update this list every month. So if your fund's not on here, we'll do our best to update it. But as we mentioned, that venture and growth kind of capital plays a role in this, but a relatively small role compared to the overall capital stack. So when we look at technology risk from the earliest stage to the latest stage, actually getting these technologies to commercial scale, we see government and industry R&D funding at the beginning. Then we see venture funding taking that past seed to maybe Series C stage. And then we see this pretty big pool of blue or valley of death at that first commercial operation stage. And that's where you're maybe a hydrogen startup looking to build your first electrolyzer. You need to raise that $50 million plus round to fund that first of a kind operation. But private capital might not be willing to fund it because it's still very risky. Commercial debt, banks aren't willing to lend to it either. So we see that valley of death still, what we call this bridge to bankability, which is where banks and commercial lenders might be willing to finance it. And this is how that stack kind of goes. We've done some work now trying to kind of track, okay, who are the sources of capital who are willing to fund beyond that venture capital and growth stage? As you can see, there's still some asterisks here. So we're working to actually pool the community together to better track these sources of capital. So seeing a lot in